Hi, let's gain an understanding of the Federal Reserve and monetary policy as a financing topic.
Interest rate. The government does not dictate the amount of interest that a lender may charge for a mortgage. Interest rates are negotiable between the buyer and the lender. However, interest rates are tempered by the supply and demand for money in the capital markets. The more consumers borrow via credit cards, mortgages, and car loans, the higher the interest rate. Interest rates fall as consumers choose to borrow less. This process of supply and demand influencing interest rates in the credit markets is part of the free market. However, interest rates are manipulated by central banks and the government through the actions of the Federal Reserve. When the Federal Reserve creates a surge in the money supply, interest rates drop. The Federal Reserve System, known as the Fed, is the central banking authority of the government. The Fed was established to provide a safer and more stable monetary system and to influence the availability and cost of money and credit. It conducts monetary policy through three ways: open market operations, discount rate, and reserve requirements. The Fed also has regulatory and supervisory responsibilities over banks created by TILA and Equal Credit Opportunity Act. Fed monetary policy, open market operations. The sale and purchase of U.S. securities is the principal method and most effective tool used to influence supply of available money. This directly increases or decreases the amount of money available as loans in the primary market. As more money is available, interest rates naturally drop. As money disappears, interest rates increase. This is known as open market operations. The Federal Reserve's approach to the implementation of monetary policy has evolved considerably since the financial crisis of late 2008. From the end of 2008 through October 2014, the Federal Reserve greatly expanded its holding of longer-term securities through open market purchases with the goal of putting downward pressure on longer-term interest rates and thus supporting economic activity and job creation by making financial conditions more accommodative. Fed monetary policy, discount rate. The discount rate is the interest rate charged to commercial banks and depositories for loans received from the Federal Reserve Bank. Banks often borrow the money they lend to consumers. Adjusting the discount rate is the second most common method to control supply of money. It has the greatest impact on the cost of short-term interest rates. Lenders will pass on the higher costs of the loans to the consumer by charging a higher interest rate. Plus, when it costs more for banks to borrow money, the banks end up borrowing less money, which means the banks have fewer loans to offer to reduce the supply of money to the consumer. Fewer loans to borrowers means more borrowers competing for the same loans. As a result, the interest rate charged to the consumer increases even more. Decreases in the discount rate have the opposite effect. There is more lending with an increase in money supply. Adjustment to the discount rate is considered the least effective way to influence the interest rate charged with real estate loans. Fed monetary policy, reserves requirement. Banks are regulated as to how much of their own money they may lend compared to how much they must have on hand. This is dictated as the Federal Reserve requirement. Banks qualify as having the money on hand when it is actually cash in the bank's vault or deposited at the local Fed bank. Adjustments to the reserve requirement have the most important impact on the supply of money. A small increase in reserve requirement causes a large reduction in money supply, whereas a small decrease in reserve requirement causes a large increase in money supply. In summary, the Federal Reserve System is the central banking authority in the United States. It was established to provide a safer and more stable monetary system and to influence the availability and cost of money and credit. The Fed conducts monetary policy through open market operations, discount rate, reserve requirement. The Fed also has regulatory and supervisory responsibilities over banks and created TILA and Equal Credit Opportunity Act.